Regulatory changes in financial markets play a crucial role in shaping the landscape of global finance. As financial markets evolve, driven by technological advancements, economic shifts, and emerging risks, regulators continuously adapt their frameworks to ensure stability, transparency, and fairness. In this video of regulatory changes, the major recent developments, and the implications for financial markets and participants. Before starting, don't forget to like and subscribe to our channel for more future updates. Drivers of regulatory changes. Several factors drive regulatory changes in financial markets, including technological innovation, financial crises, evolving market practices, and global economic developments. Technological innovation. Technological advancements, such as the rise of fintech, digital currencies, and algorithmic trading, have significantly impacted financial markets. These innovations introduce new opportunities and risks, prompting regulators to update their frameworks to address issues like cybersecurity, data privacy, and market manipulation. For example, the rise of cryptocurrencies and blockchain technology has led to increased scrutiny and new regulations to prevent fraud and ensure consumer protection. Financial crises, such as the 2008 global financial crisis, highlight vulnerabilities in the financial system and prompt regulatory reforms. Crises often reveal gaps in existing regulations, leading to the implementation of new rules to enhance stability and prevent future crises. The 2008 crisis, for instance, led to significant regulatory changes, including stricter capital requirements for banks and the establishment of the Volcker Rule to restrict proprietary trading. Evolving market practices. Changes in market practices and the introduction of new financial products require regulatory adjustments. For example, the growth of high-frequency trading and complex financial instruments, such as derivatives and securitized products, has led regulators to develop new rules to ensure market integrity and protect investors. As financial markets evolve, regulators must continuously assess and adapt their regulations to address emerging practices and products. Global economic developments, such as shifts in economic power, trade policies, and international financial integration, influence regulatory changes. As financial markets become increasingly interconnected, regulators must coordinate their efforts to address cross-border issues and promote global financial stability. International regulatory frameworks, such as those developed by the Financial Stability Board, FSB, and the Basel Committee on Banking Supervision, play a key role in shaping national regulations and fostering global cooperation. Major recent regulatory developments. Recent years have seen several significant regulatory developments in financial markets, reflecting the need to address evolving risks and market practices. Post-financial crisis reforms. In response to the 2008 financial crisis, numerous regulatory reforms were introduced to strengthen the resilience of the financial system. Reforms include Basel III. Basel III introduced new capital and liquidity requirements for banks, aiming to enhance their ability to absorb shocks and withstand financial stress. The framework includes requirements for common equity, leverage ratios, and liquidity coverage, as well as measures to address systemic risk. Dodd-Frank Act. The Dodd-Frank Wall Street Reform and Consumer Protection Act implemented comprehensive reforms in the U.S. financial system. Key provisions include the Volcker Rule, which restricts proprietary trading by banks, and the creation of the Consumer Financial Protection Bureau, CFPB, to oversee consumer protection in financial products and services. MiFID II. The Markets in Financial Instruments Directive II, MiFID II, is a European regulation that enhances transparency and investor protection in financial markets. It includes provisions for pre- and post-trade transparency, trading venue regulation, and investor protection measures. Cryptocurrency and digital asset regulation. The rise of cryptocurrencies and digital assets has prompted regulatory responses worldwide. Developments include regulation of initial coin offerings, ICOs, Many jurisdictions have introduced regulations to govern ICOs, aiming to protect investors and prevent fraud. For example, the U.S. Securities and Exchange Commission, SEC, has provided guidance on whether ICOs constitute securities offerings, subjecting them to existing securities regulations. Anti-money laundering, AML, and counter-terrorism financing, CTF, rules. Regulators have expanded AML and CTF requirements to cover cryptocurrency exchanges and wallet providers. The Financial Action Task Force, FATF, has issued guidelines to ensure that virtual asset service providers comply with AML and CTF standards. Central bank digital currencies, CBDCs. Central banks are exploring the development of CBDCs as a way to modernize payment systems and enhance financial inclusion. Regulatory frameworks for CBDCs are being developed to address issues such as monetary policy implications, financial stability, and privacy. Environmental, social, and governance (ESG) regulations. The growing focus on ESG factors has led to the introduction of regulations aimed at promoting sustainability and corporate responsibility. Key developments include disclosure requirements. Regulators are implementing disclosure requirements for ESG-related information. For example, the EU's Sustainable Finance Disclosure Regulation, SFDR, mandates that financial institutions disclose the sustainability risks and impacts of their investment decisions. Green bonds and sustainable finance. Regulatory frameworks for green bonds and sustainable finance are being developed to support environmentally sustainable projects and investments. The EU's taxonomy regulation provides a classification system for sustainable economic activities, guiding investors and issuers in their sustainability efforts. Corporate governance codes. Corporate governance codes are being updated to include ESG considerations, encouraging companies to adopt responsible practices and disclose their ESG performance. These codes often cover issues such as board diversity, executive compensation, and environmental impact. Data privacy and cybersecurity. The increasing reliance on digital technologies has raised concerns about data privacy and cybersecurity. Key regulatory developments include General Data Protection Regulation, GDPR. The GDPR, enacted by the European Union, establishes comprehensive data protection and privacy standards for organizations handling personal data. It includes provisions for data subject rights, data breach notifications, and penalties for non-compliance. Cybersecurity regulations. Regulators are introducing cybersecurity regulations to protect financial institutions and their customers from cyber threats. For example, the U.S. Securities and Exchange Commission, SEC, has issued guidelines on cybersecurity risk management and disclosure for public companies. Implications for financial markets and participants. Regulatory changes have significant implications for financial markets and participants, affecting their operations, compliance obligations, and strategic decisions. Increased compliance costs. Regulatory changes often result in increased compliance costs for financial institutions. Banks and investment firms must invest in systems, processes, and personnel to meet new regulatory requirements. This can include expenses related to reporting, auditing, and implementing new technologies. Smaller firms may face greater challenges in absorbing these costs compared to larger institutions. Enhanced market integrity and stability. Effective regulation enhances market integrity and stability by addressing risks and promoting transparency. Reforms such as Basel III and MiFID II aim to improve the resilience of financial markets and protect investors. By reducing systemic risks and ensuring fair practices, regulatory changes contribute to a more stable and trustworthy financial environment. Opportunities for innovation. Regulatory changes can create opportunities for innovation in financial markets. For example, the development of CBDCs and the regulation of cryptocurrencies open new avenues for digital financial products and services. Financial institutions and fintech companies can leverage these opportunities to create innovative solutions that meet evolving market needs. Increased focus on ESG factors. The emphasis on ESG regulations reflects growing investor demand for sustainable and responsible investment options. Financial institutions are increasingly incorporating ESG factors into their investment strategies and decision-making processes. This shift can lead to the development of new financial products and services that align with sustainability goals and address societal challenges. Challenges in adapting to new regulations. Adapting to new regulations can be challenging for financial institutions, particularly those operating across multiple jurisdictions. Navigating different regulatory frameworks and ensuring compliance with evolving requirements can be complex and resource-intensive. Institutions must stay informed about regulatory changes and invest in compliance infrastructure to manage these challenges effectively. This is it for today's video. What do you think of our video? Comment below with your thoughts and let us know. Don't forget to like and subscribe to our channel for more future updates. Thanks for watching.